वक्रतुंड महाकाय सूर्यकोटि समप्रभ निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा त्वमेव माता वक्रतुंड महाकाय त्वमेव बन्धो च सखा त्वमेव विद्या द्रविणं त्वमेव सर्वं मम देव कायेन वाचा मनसेन्द्रिये वा बुद्ध्यात्मना वा प्रकृति स्वभावात् करोमि यद्यं सकलं परस्मै नारायणायेति समर्पयामि गुरु ब्रह्मा गुरु विष्णु गुरुर्देवो महेश्वर गुरु साक्षात् परब्रह्म तस्मै श्री गुरुवे नमः तस्मै श्री गुरुवे नमः। ॐ सहना भवतु सहनो भुनक्तु सह वीर्यं करवावहै तेजस्विनावधीतमस्तु मा विद्विषावहै। ॐ शांति शांति शांति। सर्वने जय श्री कृष्ण।
Sarvani Jai Shri Krishna. Welcome Depesh Bhai Joshi and Depesh Bhai YouTube. Depesh Bhai, sorry, my Amara Jamai che Depesh Bhai Joshi. So if I have been saying, I do apologize. Thank you, Ba. See what I mean? Ba is always sticking, and she keeps me in line. I do apologize, Depesh Bhai. You are co-host, so you'll be able to unmute. Paresh is just putting live on YouTube. Jai Shri Krishna, Jai Jinendra, Depesh Bhai.
Jai Jinendra, Jai Shri Krishna. Hello to everyone. Thank you, Paresh Bhai. Thank you, Rohini Ben. And nice to see everyone from the RPM family for today's presentation on maximizing tax benefits before the tax year end. So like Rohini Ben said, sometimes people think, oh, we've got plenty of time to go before the tax year end. With tax year end planning, it could actually be done anytime during the year, but for some reason, majority of people always leave it till February or March. So what the presentation will go through is some of the planning that you can consider, some of the planning that will help you to mitigate some tax and ultimately to help you save money or increase the value of your wealth over a period of time. So what I'll do is I'll start the screen sharing. I'll go through the presentation slides. Like Rohini Ben has mentioned, if you have any questions, please make a note of them, put it in the chat or in the WhatsApp, or if you're happy to just ask the question, that's fine. We'll try and get through all the questions. I think the presentation will take around about 45 minutes, and then we've got some time for question and answer. And if some people don't feel comfortable in asking the question in front of everyone, then please feel free to contact me by email or telephone, and we can discuss in more detail. Okay, so good. So this is all working. So welcome to today's presentation. My company, Oakdale Financial Services, is a partner practice for St. James's Place. We've been looking after many people's financial situation, helping them with their financial planning for many years. So today's presentation is all about tax year end planning before the 5th of April 2022. So we've got just over 5 weeks, and the next 5 weeks will go by very quickly. So we unfortunately we don't have probably as much as time as we think we have. So today's presentation focuses on the crunch time to get the most from this year's tax allowances before the 5th of April 2022. So this page here we'll look at. We'll start by looking at my role as a advisor. So my role is really to get to understand your situation, understand what's important to you from a business point of view, from your personal point of view as well. We need to understand your aspirations, your goals. Basically, what's important to you, what are the key highlights for you, or the key drivers in terms of your money, your wealth as well. We need to understand your current situation, the assets that you have, what you're expecting to have in the future, and how you're planning to use those assets, what sort of lifestyle you'd like at the point of retirement. So really important that you start thinking about all of these things from as soon as possible. And we know that financial planning can be complex. There's a whole range of complicated products. There's a whole lot of jargon. I try and keep things as straightforward, as simple as possible. Of course, we know that legislation will change in the future, taxation, budgets, and as a result of recent events such as the coronavirus, where the government's had to put into a lot of money to support the economy, they're now looking to recover some of that money as quickly as possible. And one way that they're looking at doing that is putting up interest rates, of course, and they're also looking at how they can increase the amount of taxation. So where we can take advantage of any opportunities within tax planning, really important to do that. I also work with other professionals such as solicitors, accountants, because sometimes the question or the query cannot just be dealt with by one person. So it's about making sure that we're able to give you the best possible answer, covering different issues that might come up as well. So key message for today's presentation will be: don't let your tax allowances go to waste. Now, we know it's not too late to take full advantage of the tax relief and allowances available to you for the tax year. So today we'll have a look at some of the opportunities available. And it's about a case of taking the right actions at the right time. And this will really help you to achieve your financial goals and your well-being. You've got to think what's important to you, what your key priorities are. The key to planning your financial future is to use the right ingredients to make the right recipe. So when we talk about ingredients, we're talking about the different types of financial tools or financial planning that's going to be available for you to utilize. And whatever your financial goal is, we know that everyone has different goals, different aspirations. They also have different experience or different starting point. I'm confident that with the advice that we're able to provide you, we'll be able to help ensure that you maximize your allowances and reliefs. But essentially, we don't want these allowances to go to waste. We'll have a look at which financial goals are most important to us. So different people will be at different stages in their financial journey. So the key things here are depending on So just one second. Right, sorry about that. So which financial goals are most important to us? So depending on what stage you're at. So the first stage will be, for example, you're just starting up in your financial planning journey. You've just started work, maybe your first job, you're getting your first income coming in, and you're thinking about putting together the steps in place that will allow you to build a foundation. So at this stage, you're thinking about making some investments. You'd like to make your money work harder for you. Things that you might be thinking about in the future will be things like, for example, buying your first home or planning for a property, planning for a family. So whatever you're thinking, it's important that you build a good solid, strong foundation that will withstand the test of time. Now, for this foundation, we might recommend, for example, an ISA, a unit trust, and it might also involve making use of your personal savings allowance. The next stage is, before we go on to the next stage, it's important to remember, if you're thinking about buying your house, buying the first house, then with inflation, the cost of property is going to increase over the next few years. So therefore, it's important that any money you're saving, you're building up, is also growing in line with inflation. Otherwise, it means when you're in a position to buy a property, you might not necessarily be able to buy your ideal property because property prices have pushed up. You might not have built up sufficient deposit. The next step, the next financial goal we'll look at is in terms of securing your and your family's financial future. So here we're thinking about making the most of your investments. You're thinking, okay, you've got your children, you'd like to give your children a good start in life. And even if you just start contributing a small amount per month, that small amount will build up over a period of time, certainly over a long period of time. And that will be a nice lump sum to help the children in the future. And this could be to pay for things like university fees, first car, first property. So whatever you can do, it will certainly help your family, your children in the future. And you should also now be thinking about building funds to allow you to have a comfortable retirement. So although it might seem a long time away, the years will soon disappear very quickly. And whatever we do now is going to have a big impact on what happens in the future and the type of lifestyle, the type of retirement we can have in the future. So we're now moving over to the third box, which is in terms of retiring in style. So if you're thinking about living life to the full in retirement, even if you're not there, we still have to think about it. We have to make sure that you do not run out of money during retirement. So we know for a fact that people are living longer and longer. Average life expectancy is increasing. Cost of living is becoming more expensive. So therefore, it's even more important that you ensure that you have sufficient funds to last you the whole of your retirement. So average age at the moment, life expectancy is 85, 86. So if you stop working at 65, you need to fund a retirement for 25, possibly 25, 30 years in some cases. And you need to ensure that your investments are working hard for you and your loved ones. So here we talk about, again, ISAs, unit trusts, pensions, retirement planning, all of that stuff is important. And we're now coming up to the final stage in the life journey. And now you've enjoyed a good working life, a good career. You've built up sufficient funds to allow you to have the retirement that you want. This is the next stage, the final stage is in terms of making sure we're able to pass on your wealth in a tax efficient way to help your family. So we want to reduce the amount of tax that you pay overall. We want to ensure that we give your loved ones a really, really good start in life. So it's giving away money where possible, helping your children, your grandchildren, and it's about taking advantage of the different tax allowances, the tax planning that we can look at for you. And of course, continuing to get the most out of your retirement and also your family's future. So there's a whole range of these different financial situations, financial scenarios that are taking place. Now, they're not literally like 1, 2, 3, 4. They don't happen step 1, step 2, step 3, step 4. They kind of merge together, and I think they're all important at the same time. Some things which seem a long time away, that long time is probably not as long as we think it is. So it's important that we think about the short term, the medium term, and the long term all at the same time, because unfortunately time goes by quickly. So we'll now have a look at why you should invest in an ISA. ISAs are great investment vehicles. They've been around for a long time. And the great thing that we like about ISAs is the tax efficiency of ISAs. Any money that you put into an ISA, free from income tax, is free from capital gains tax. You don't pay dividends. So any interest you receive, if it's a cash ISA, there's no gains, there's no capital gains tax to pay. If you're holding shares and you receive dividends, then again, there's not going to be any dividends to pay on money held within an ISA. So really tax efficient way of investing your money. And I would recommend that every single person should really have an ISA. Maybe you've got money in a cash ISA, but certainly medium term, long term ISAs is a good way to start investing in stocks and shares, building up your assets for the future. And the key thing with the ISA is you've got a £20,000 allowance, and it's really important that you make use of this allowance. Whether you put in a small amount, a few thousand, right up to the £20,000, whatever it is you're happy to put in, you should certainly consider making use of ISA allowance, because if by the time we get to the 6th of April this year, 6th of April 2022, any unused allowances in an ISA cannot be utilized. So we don't want to waste any allowance if possible. Here we're talking about keeping ahead of inflation. So we're having a look at the moment, interest rates are at all-time low, and they're below the rate of inflation. So if you're investing in your cash ISA, it means that your money is losing value in real terms. So what we're saying is investing in a cash ISA may not be the best place for you to invest your money if you're looking to invest for medium to long term. So some money, some rainy day money, some emergency money, yes, it makes sense to keep it in a cash form because you may need access to that money. We're going to have a look at a chart on the next page that will show you that over the last 10 years, from January 2011 to December 2020, the annual returns from a cash ISA would almost have always been below the level of inflation, resulting in a real losses for you. So what we're saying is, for the last 10 years, if you look at the rate of inflation, the rate of inflation has been more. The rate of savings, the return you get on investments has been very low. The interest rates have been low. So whilst the rate of inflation is higher than the rate that you're receiving on savings, this means you're losing money in real terms. So for example, we know that the cost of living is increasing. You go to the supermarkets, you look at your shopping, you compare that to what you would have spent maybe 5 years ago, you'll see that it's costing you a lot more for the same type of goods and services that you're buying at the moment. You look at your energy prices with things that's going on in the world at the moment. Energy crisis, some of it is to do with shortages. We've had problems with the lorry drivers. So we've had shortages in the supermarkets, and we've also seen inflation go up. So shortages, inflation, we can see that there is going to be certain problems further ahead in the future. Now, inflation is currently 4%. I think it's probably slightly higher. When I'm looking at the cost of living, I think between now and last year, I think it's certainly gone up by more than 4% across the board. So inflation is 4%. The best cash ISA that we've managed to find at the moment is 0.67%. So you can see what the problem is: high inflation, low interest rates, ISA returns, cash ISA returns have been poor for a number of years. So what we're saying is we need to really think about investing. If we're investing over the medium to long term, stocks and shares is really good, because the growth that you will get will mean that you're getting better returns than leaving it in cash. Your money is staying ahead of inflation, and that's so important. We need to make sure that the money maintains the purchasing power in the future. Otherwise, we're getting poorer and poorer in real terms. So here's the graph that we've mentioned so far. So what we'll see is the green line here is the annual inflation rate. So you can see the green line here. And the majority of time, the rate of inflation has been higher than the cash ISA return shown by this pink line. So this is just demonstrating the impact of your money going backwards in the bank account. So I said previously that adding a little bit of money each year, whether you put it in on a monthly basis, you have some surplus income each month, you should really be putting that into some sort of investment, getting your money to work harder for you. Or if you've got some lump sum at the end of the year, you should certainly look at putting this money and making sure it's growing for you. Bear in mind that we're looking at the power of compounding. So even if you're putting in relatively small amounts into your stocks and shares each year, this is going to make a big difference in the long run. Now, the key thing with compounding is the longer you do the compounding for, the longer you leave the investment to grow, the better, the stronger, the more powerful the compounding will be. And you'll see that in the returns on your investments. And this will apply to all asset classes that we're talking about. Asset classes where you invest over a long period of time, the longer you leave it, the better it will be over a long period of time. The figures show how investing, so on the next page, the figures will show how investing £5,000 per year into a stocks and shares ISA, the value of your money grows by reinvesting. So any profits are being reinvested back into the ISA. You're not paying any tax on interest or profits. So compounding plus tax efficiency gives you a really powerful formula to increase the value of your money. So what happens here, you're putting in £5,000. At the end of 5 years, you've put in £25,000. And it's showing you with some growth that could be worth £26,858. Over 10 years, you've put in £50,000. And it could be worth £57,000. And over 20 years, you put in £100,000, it could be worth almost £130,000. So it's just giving you some idea of how just investing on a regular basis can be extremely beneficial for your long-term financial wealth. Here we're talking about investing in an ISA. We're talking about helping to give your children a good start in life. So like adult ISAs, you can have children's ISAs, you can have cash ISAs, you can have investment ISAs. Junior ISAs must be started by the parents or the grandparents. It allows you to save money tax efficiently for children up to the age of 18. So sometimes when they get birthday money, Christmas money, Diwali money, presents, so sometimes it might be nice to put it into an ISA and let that money grow. So like the main ISAs that we've talked about for adults, the junior ISA is free from income tax and capital gains tax. So really nice way to start building up money for the children. Then when the children get to the age of 18, they can carry on building this money. They can see that how it's built up over a long period of time, and hopefully it gets them into the habit of saving and building up their funds as they become young adults. So a junior ISA is a good way to gift money to your children, which also reduces your inheritance tax liabilities, and it will help by removing money from your estate, which we'll have a look at in one of these later slides. So just a summary here, £20,000 per person can go into an ISA, so £20,000 for an individual, £40,000 for a couple, and £9,000 per child can go into a junior ISA. So these can be either stocks and shares, cash, or you could do a combination of the two. The key thing with ISAs, one of the key benefits is that all ISAs, junior ISAs, are free of income tax, capital gains tax, and dividend tax as well. So you don't pay taxes on when you receive any interest, when you make any profits as well. And the other thing that we have to point out is that the tax benefits for ISAs is on a use it or lose it basis. So what that means is you can't roll it over into another year. So think about opening an ISA, or if you already have an ISA, top up your existing ones, and you have until the 5th of April. But of course, don't leave it to the last minute, because things will happen last minute, and sometimes it might not always be possible to get it done on time. So we're now having a look at the personal savings allowance. So what we're talking about here is looking at ways of being smart with your cash, with your money. The personal savings allowance, the PSA, it means that there's no tax on some of the interest. So where you've got money in bank accounts, you're able to use the personal savings allowance and you won't pay any tax on this money. However, the personal savings allowance means you might not need to hold it in a cash ISA to avoid paying tax on the interest. So what we're saying here is that the rate of cash ISA is very low. Like I said, probably the best one at the moment is around about 0.67%, because the interest rates are very low. You're not going to find much better in terms of cash ISAs. But what we're saying is you don't need to hold all of this money in a cash ISA, because where you've got the money, you could also get it tax-free by using your personal savings allowance. This means that money that you've got in a cash ISA because you think it's tax efficient. My question would be tax efficient of exactly what are we talking about? So when you're getting a rate of 0.67 for most people, that's probably not really going to be that exciting. So what we can do is what we're saying is, rather than keep your funds tied up in a cash ISA, you could look at an investment ISA, which will have more potential to grow over the medium to long term. So here, based on these interest rates, it says that it shows you the amount you could hold in a basic account, in a cash account, before you have to pay the tax on the interest. So if you're a basic rate taxpayer, a 20% taxpayer, you could have almost £150,000 before you would end up utilizing your personal savings allowance. And if you're a high rate taxpayer, it's almost £75,000. So obviously these figures are based on the current low interest rates. If the interest rates were to increase a little bit, then the amount you'd be able to hold in your account before paying tax will be slightly less as the interest rates increase. But nevertheless, you can still see that it's still a fair amount of money just to be holding in cash. Most people, most clients we know don't really just hold that much in cash for the sake of holding it in cash. So let's have a look at your personal savings allowances for 2021, 2022. If you're a basic rate taxpayer, you can get up to £1,000 per year of interest tax-free. If you're a high rate taxpayer, it's reduced to £500 per year. And if you're an additional rate, i.e. a 45% taxpayer, then it's zero, your allowance. What about the 60% tax trap? We have to watch out for this one. This one, unfortunately, catches a lot of people unaware. 60%, you're probably thinking, what do you mean 60% tax? Well, if you're earning less than £100,000 per year, then the first 12,570 of that is going to be free of income tax for most people. However, there is something in the UK taxation system which says that if your earnings are between £100,000 and £125,140, then what will happen is your personal allowance will reduce by £1 for every £2 you earn, in effect taxing you at 60%. So if your income is £125,140, you will lose the full £12,570 personal allowance. So we'll have a look at what happens in this scenario. So let's say, for example, your annual income is £100,000. You receive a bonus from work of £10,000. So your total income is £110,000. Now, we're interested in the £10,000. So on the £10,000, you're a 40% taxpayer. So you're going to pay £4,000 tax on that. You're also, because it's £10,000, based on this, for every £2 you're above, you lose £1 of allowance. So that means you will lose another £5,000 of this personal allowance. By losing this £5,000 of allowance, it's going to cost you an extra £2,000 in tax. So 5,000 at 40% is £2,000. So you add up the 4,000 plus the 2,000, that gives you 6,000, which is 60% of £10,000. So it's a very high, very expensive, and you don't really want to end up losing your personal allowance, because by doing so, you're going to end up paying a lot more tax. Now, luckily, there's a number of ways that we can avoid this trap. One of them would be, for example, you could pay in earnings over £100,000 in your pension. So, for example, if your income is £110,000, as in this case, you could put the £10,000 into your pension. that way, that will bring your income back down to £100,000. That way you'll keep hold of your personal savings allowance. You'll get 40% tax relief on your pensions. So usually 20% is given to you at source, and another 20% you need to claim through your self-assessment. So that's a really, really good way of holding on to your personal allowance. Put the money into your pension, and you're putting that money into your own pocket, which you'll be able to get access to later on in the future. So pensions here, we're looking at how it can help you. Why pensions really are one of the best ways to save for retirement. And this is because of the tax reliefs that the government gives you. So this year, providing you've got income or earnings of up to £40,000, if you're employed, you could put in a maximum of £40,000. If you're a company director and you're paying yourself a small salary and take out the rest as dividends, then the company can make a pension contribution on your behalf. So here we're looking at, when you're putting money into a pension, we're looking at an example of £100. So if you're a basic rate taxpayer, you're going to put in £80 and the government will put in £20 into your pension. If you're a high rate taxpayer, you're going to put in £60 and the government will put in £40. And if you're an additional rate taxpayer, a 45% taxpayer, you're going to put in £55 into your pension. The government will put in £45, so that will give you £100. So either way, whichever tax bracket you fall into, it's really important that you maximize your pension contributions. You get the money into the pension, you benefit from the tax reliefs that I've mentioned, and you grow the money, you benefit from compounding, and certainly that will make a difference. The earlier you can start, the better it'll be. And this will show you on this slide here. So what we say with pensions, with ISAs, with any of these sort of vehicles, you should really try and put in as much as you can from as early as you can. The longer you leave the money to invest, the better it's going to be over the medium to long term. And here we're saying top up as much as you can before tax year on 5th of April. It's never too late to start saving. So even if you think you haven't really started building up your pots, it's never too late. You should always try and start as soon as possible. Now, in this example, we're saying that, let's say that you're looking to retire when you're 67 and you make gross contribution towards your pension of £200 per month. So what this means is if you start saving at age 20, you could have a pension pot worth £349,000. If you leave it a little bit later till the age of 30, then your pension pot is going to decrease and it will be around about £215,000. And if you start at the age of 40, because you've got less time to grow this money, you've got less benefit of the compounding, the powerful compounding that I've spoken about, you will get a figure around about £123,000. So what we're seeing is the cost of delay is massive. The longer you leave it, the less you're going to get in the future. The only way you're going to get more is by putting in significantly more contributions. The later you leave it, the more money you're going to have to put in. So in some cases, it becomes more difficult. Whereas if you've started from the early age of 20, you've kept it at £200, that's going to be a nice sum of money based on the fact that you've got a long time for this money to grow. So the key thing is, we've mentioned to start saving as early. One of the questions you need to think about is what sort of retirement would you like? So I know a lot of people don't really think about retirement now. It's still usually a long time to go. You're busy with work, family, children, paying bills, etc. But the years will soon disappear. So what we'll have a look at is on the next slide, we'll have a look at some ideas of some pension contributions, what it could get you. So we've got a scenario, we've got 3 scenarios, a minimum scenario, which will give you a basic form of living when you get to retirement. That might allow you to have one holiday a year. The moderate lifestyle might allow you to have a bit more comfortable lifestyle, maybe a couple holidays a year. And the comfortable is having a nice pot of money to be able to help you at the point of retirement, to really have the lifestyle you want. So we've got to start thinking about these things as soon as possible. Time won't wait for anyone, but take advantage of tax reliefs, compounding, tax efficiency, growth of investments. And also, I'm sure I'll probably get this asked as a question. Right now, you've probably been looking at the news. You've probably seen things that have happened today where Russia has invaded the Ukraine and the stock markets have fallen. So some people will naturally think, okay, this is not a good time to invest. But for us, we would say to people, this is actually the best time to invest the money. The markets have fallen. The companies that the fund managers are investing in are still perfectly good companies. The companies might make a little bit less profit overall, but they're still going to be good companies. So what we say is, when these opportunities happen where the market drops like this, it's a good opportunity because investments are always going to be medium to longer term investments. The same thing happened with the coronavirus. We were talking to our clients. We said, look, coronavirus is a good opportunity to put the money in. And a lot of times people would like to wait and see the markets go up. But if you can buy it when the market is low, you'll get, yes, there will be some short-term volatility, of course, but over a period of time, the markets will sort themselves out and the markets will increase in value. And those who invest the money during those times will see good returns over a period of time. One of the sayings that I've come across, which I think is a really good saying, is never waste a good crisis. So in a crisis, things like coronavirus, things like the invasion of Russia invading Ukraine, of course, it's not very nice from a human. Markets will give good opportunities. So invest in a pension. So here we're looking at the sort of allowances that you're going to have available to you until for the end of this tax year, 5th of April 21-22. So you can get income tax relief on 100% of your earnings up to a maximum of £40,000. So really good to utilize those earnings. You'll also get tax-free cash at the age of 55. Now, what used to happen a long time ago was that people used to put their money into the pension, and then the idea was around about 55, they'd look to take their tax-free money out from the pension. But nowadays, because people are living longer and longer, at the age of 55, they're really taking the money out. They're increasing their pension contributions, and they're looking to increase the value of their lump sum. And if we can increase the value of the lump sum, then that means your 25% that you're entitled to will be a bigger tax-free money. So for an example, if your pension at the age of 55 is £100,000, then your tax-free money, 25% will be £25,000. If you leave it, let's say you don't need the money at 55, you're still working, and you leave it till the age of 65, if your pension now is worth £200,000, then that means you can take out £50,000 tax-free. So again, there's some opportunities there. There's also the ability to carry forward unused pension allowances from previous tax years. So if you've got good income, you've got unused allowances, then we would consider using up those unused allowances. So what you have to do, first of all, you have to use the current year allowance, which is 2021/2022. Once you've done that, you're then able to go back 3 years. The first of 3 years will be 18-19. You can fill that one up, because once we get to 6th of April, once we move into the next tax year, then the 18-19 tax year will drop off. It'll be forgotten about. It'll no longer be available. 19-20 will be available, as well as the current tax year, which will be 22-23. So what we're saying is, where you've got unused allowances, try and make use of these allowances, get money into the pension, benefit from the tax reliefs, and also pension money is also free from inheritance tax as well. We also have something called the lifetime allowance, which is currently capped at 1,073,100. And this, alongside most allowances like the personal allowance, the inheritance tax allowance of 1 million, the lifetime allowance 1,073,100, these have all been capped until April 2026. So what it means is indirectly, you're going to then end up paying more tax because assets will increase over a period of time. Now, the lifetime allowance, it only affects a small number of people. And again, with all of these allowances, the key date is the key message is you have to try and utilize them before the 5th of April. After 5th of April, the allowance will not be available. So here we're talking about inheritance tax planning. We're talking about in terms of you've built up your money so far. You've been able to enjoy increases in the value of the investments. Now it's really important that we start thinking about protecting your family wealth. We're thinking about options in terms of passing this money down each year. So at the moment, the minimum tax-free threshold or the nil rate band for an individual is £325,000. For a couple, it's £500,000. So after your allowance of 325, the rest of the estate is taxed at 40%. So in this example, a person has an estate of 1.5 million. Their allowance is £325,000 and 1,175,000 will be taxed at 40%, which is £470,000. So if we think about making the most of your tax-free gifting allowance, you should use your inheritance tax allowance, your annual allowance of £3,000 per year. By giving these gifts, it's a good way of reducing your estate. It helps you to help your loved ones to build up their funds, to help them for their financial future. And you have the option of investing in junior ISA or pension for your children or grandchildren. And it's a great way of utilizing your gift allowance. So you use up your gift allowance, you put it into a tax efficient vehicle and you benefit from tax benefits, and you're also getting a reduction on your estate from inheritance tax. So it can serve multiple purposes there. So here's how it works. The amount you can give tax-free per year is £3,000. This is per person. So husband and wife, between them, can give £3,000 each. So £6,000 in total. It's not based on how many children you have. It's just based on your own individual allowance. And if you haven't made any gifts the previous tax year, then you've also got a further £6,000. So that will give you £12,000 that you could give away to help your family, and that will be immediately outside of your estate from a inheritance tax estate planning point of view. Here we're looking at some allowances. So if you leave assets between spouses, there's no inheritance tax to pay. First 3 to 5,000 is available tax-free. And again, it's one of these allowances that's frozen until April 2026, as confirmed by the Chancellor Rishi Sunak. So every individual has a 3 to 5 allowance. So for a couple, it's 650. And if you own a main residence, for a couple, the limit is 1 million. And for an individual person, it's £500,000. Now, there are some rules, strict rules about your estate going to your main residence, going to your children, grandchildren, or other lineal descendants. Now, if the estate is worth more than 2 million, then there's some other additional complications. The rate of the main residence nil rate tax band will go down. Therefore, that will increase the amount of tax each year. So we've talked about this gifting of £3,000 per year. However, that might be just a small, in terms of the estate, that might be a small figure. So we'd have to look at other types of planning, other types of inheritance tax planning that will help you to bring the value of the estate down quicker. Capital gains tax. So there's also a trap with regards to capital gains tax. Just like I mentioned, there was a 60% trap if your income is above £100,000. There's a trap in relation to capital gains. So capital gains is where you make gains above your allowance, you're subject to capital gains tax. So in this scenario, let's say, for example, you've been given some free shares by your company worth £5,000. Over a period of time, the value of the shares, the company does really well, and the value of the shares is now £25,000. This means that you've now made a gain of £20,000. Now, you've got an allowance of 12,300. So 20,000 minus 12,300 will mean that your gain is £7,700. And if you're a high rate taxpayer, you're going to end up paying 20% on these gains, and you're going to end up paying £1,540 in capital gains tax. So what we're going to have a look at is some ways that we can help to reduce or mitigate the impact of capital gains tax on the sale of assets, sale or transfer or disposal of assets. So key thing is we want to make sure you don't get caught in a capital gains tax trap. There's a number of ways that we can help you to reduce your capital gains tax bill to zero. One of the things that you could do is, for example, you could hold your shares in an ISA. Now, the benefit of holding shares in an ISA is that any capital gains is free from capital gains tax. So no capital gains tax there. You could sell half the shares this tax year before the 5th of April, and you could sell some more in after the 5th of April next year. And this will bring the taxable amount down to £10,000. So therefore, there won't be any capital gains tax because it's below the annual tax-free threshold. You could, for example, consider transferring your assets to your spouse so that you can use both of your allowances. So you would have 12,300, your spouse would have 12,300. So that's £24,600 of gains that you could protect from tax. You could also do it for this year plus next year. So nearly £50,000 you're able to protect by splitting assets over different tax years. One other thing that you could consider is defer the sale of the asset until your tax position changes. So let's say, for example, you're a high rate taxpayer, and in the future, your tax position is going to become a basic rate taxpayer. So what you might do is wait till you become a basic rate taxpayer and then sell it, because basic rate capital gains tax rates are lower than high rate taxpayers for capital gains. If you're a basic rate taxpayer, you could defer it. And if in the future you're going to be a nil rate taxpayer, then again, that would be beneficial to do it that way. So let's have a look at, in terms of dividends, we want to try and make this as tax efficient as possible. So holding your investments in stocks and shares means you're liable for, holding your investments. If you hold stocks and shares and you receive dividends, then this means you're going to be liable to pay dividend tax. The first £2,000, you have what's called a dividend allowance. It's tax-free, but then afterwards, any further dividends you receive, depending on your tax status. So if you're a basic rate taxpayer, it's going to be 7.5% the rate of dividend. If you're a high rate taxpayer, it's going to be 32.5%. And if you're an additional rate taxpayer, it's going to be 38.1%. So in this scenario, you've got dividends of £5,000. You've got the first £2,000, which is free. So that means that £3,000 is going to be subject to tax. And if you end up paying tax on it, if you're a high rate taxpayer, it's going to cost you £975. Whereas if you have these dividends, if you put these shares into an ISA, then you're not going to end up paying any dividends. The rate you will pay, the rate of tax you'll pay on dividends will be zero. So clearly that's going to be quite nice to try and save some money in dividends there. Whilst we're talking about dividends, it's important to talk about a tax rise that's coming. So earlier on in the presentation, I mentioned that the rate of taxation is going to be increasing. One of the things that is coming into play from 6th of April 2022 is going to be an increase to the rate of dividend tax. So dividend tax is going to increase by 1.25% for all taxpayers, basic rate, higher rate taxpayers, and also additional rate taxpayers. So we're saying definitely worthwhile consider investing in a stocks and shares ISA, because we want to try and protect as much of this money from tax, ultimately keep more of this money in your pocket. If you're a limited company director and you're taking dividends, and you're planning on taking you're planning on taking the same dividends next year as well, it might be worthwhile to take the bigger dividend this year before the end of the tax year by the 5th of April. So you benefit from the current rates, which are lower than what it will be in the future. So if you're going to be paying yourself some extra dividends, might be very worthwhile, very beneficial just to take it out early, because you're going to pay that anyway, but it will save you a lot in terms of dividends. So this is now bringing us close to the end of the presentation. We've got what's called here your tax year-end checklist. So here we're just summarizing some of the key things, the key things that I've mentioned, the key allowances. And remember, most of these allowances are on a use it or lose it basis. So we mentioned that utilize your ISA allowance as much as you possibly can. Every year, you've got a £20,000 ISA allowance. So certainly should be trying to utilize that as far as possible. You should check if your spouse has also utilized their annual allowance of 20,000, because if you haven't, as husband and wife, you could be putting in £40,000, up to £40,000 for this year's ISAs. You've also got amounts for children, which is £9,000 for children into a junior ISA. Well worth putting the money in. The money is going to grow over a period of time. It's a tax efficient way, and you benefit from the power of compounding, which becomes better the longer the time goes. You should consider contributing into your pension, especially if you can take advantage of the full allowance, making the most of your tax efficient benefits that your pension can bring. So I've already mentioned that pensions are incredibly tax efficient, and you should try and utilize them as far as possible. If we're talking about you're coming up to retirement, you need to take a large withdrawal, then it's a case about spreading the withdrawal over 2 years. So if we plan these things, then this will certainly help you to reduce your tax liability. If you're a high rate taxpayer, you can bring your taxable income down by putting money into your pension. So key things is with the pension, if your earnings are over £150,000, you're going into the 45% tax bracket. You could make a pension contribution to bring you back down to 150 to put you back into a 40% tax bracket, which is better than paying 45%. We mentioned if your earnings are between 100 and 125,140, pension contribution is going to be a great way to hold on to your personal allowance. Where you've got child benefit, if your income is over £50,000, your child benefit starts getting reduced. So if you can, if your income gets to if your income is £60,000, then at that stage you're not going to receive any child benefit. So in order to keep hold of the child benefit, it's definitely going to be worth your while putting money into a pension. We talked about annual allowances, £3,000 you can do each year per person. And the good thing with this is you're helping the children to build up a sum of money for their future, but it's also outside of your estate and won't be liable for inheritance tax. We talked about dividends, cost of dividends. Dividend tax is going to increase. So where possible, if you're taking dividends and you're going to be paying yourself some dividends next year, you're running a business, then try and pay yourself a little bit early this year. Remember, the first £2,000 of dividend income is tax-free. And then diverting your company's pre-tax profits. So if you're running a company, any profits you're making is going to be subject to corporation tax. Now, the problem with if you're running a limited company, you're normally taking out enough salary, enough dividends to cover the cost of your lifestyle. There's no point taking more money out, because then you're going to end up paying more tax. There's no point leaving the money just in a bank account, because the bank account does not earn any interest at the moment on business money. So the best thing you can do is put money into, the company can put money into a pension. You'll save corporation tax relief at 19%. And the good thing is it's not limited to 100% of your earnings, as if the case. So 100% of earnings is only relevant if you're employed. If you're the company director, the company can put in this money into your pension pot, reduce your corporation tax. There's no income tax to pay, and there's no national insurance contributions. So clearly it's very efficient from that point of view. So thank you for listening to the presentation. I hope you all enjoyed that. It's given you some food for thought, some things that you should certainly consider in terms of the various allowances, and things that you could be doing or should be doing, and maybe you're not doing, maybe the accountants haven't told you, but there's a whole range of things in there. By making use of all of these allowances, that then helps to protect your financial future and build up your funds for your family. So thank you for listening. Yeah, about 45 minutes, just like I said, 45 minutes. Yeah, we're now open for any questions that anyone has now.
Depesh, that was absolutely excellent. Rohini, did you want to elaborate on anything in particular?
No, I think most of them have understood. Well, for our questions, Depesh, we will go through it. Some of them are direct on this one. Right, let's start from the beginning. But first of all, thank you very much, Depesh. Thank you. I mean, મેસેજમાં પણ આવ્યું છે કે તમે ભલે ઇંગ્લિશમાં બોલ્યા છો પણ એટલું સિમ્પલ રીતે બોલ્યા છો કે લગભગ બધાને સમજાઈ ગયું છે. So you have made it very as best as simple in a possible manner that you could, that people can understand. So thank you very much for all your efforts. Really.
We always try to keep it simple, because tax is already a complicated. Tax is a taxing subject, and I'm thinking it's 8 o'clock. People have probably had a long day, so I just try and keep it nice and simple. The concept, explaining it, obviously it's more complicated, but I've tried to hopefully everyone can take away a little bit of what we've spoken about today and how it can help them.
Yeah, thank you very much.
Okay, so do you want to go through?
I think Bharat Bhai Nuche, just a thought for later. I hear some people's pension pot could disappear from some company or reduced if pension pot not done well, etc. Even example, NHS staff may lose out. How to monitor pension pots? Is that?
I think there's about three questions in there. In terms of pension pots, you should. So the first thing is with pensions, nobody really reviews how their pension is performing, because what happens is we always think, it's a long time to go, we don't need to worry about it. They're going to send you a statement each and every single year. Now, I know for a fact, when I speak to the majority of my clients, I ask them, what do you do with that statement when it comes in? And you'll probably do exactly the same thing. Most people say to me, all I do is I get it and I put it in my file. That's all I do. I don't do anything else with it. And the other thing that happens is with pension paperwork, when it comes in, I have to be honest, I think sometimes it's not always the most friendly type of paperwork or friendly thing that you can understand quickly or easily. So what I would say, it's important to review your pensions. If the pension is not performing, you should look to make some changes in terms of the funds. Now, some funds may have been good before, but maybe there might have been a fund manager change. There might have been a change in investment styles. Something may have come into favor or gone out of favor. But with a lot of investments, the key thing is over the long term. If you're investing money over the long term, then you should not be losing any money. You might not make as much money, maybe, but medium to long term, you shouldn't be losing any money. I've been investing money since 1995, since I started working. So I've always invested money for long term. And like I said before, if there is a crisis like right now, then from an investment point of view, it is a good opportunity, providing you're prepared to invest for medium to long term.
Thank you very much. I'm sure Bharat Bhai has got his reply. Next question. What is the current amount for children's ISA?
£9,000 per child.
Wow, okay. £9,000 per child. Thank you. Harish Bhai is asking, I have filled my return and paid my tax for last year. HMRC have sent me an email and text to do so. So do I ignore them or contact them? He's already done the tax return. So
you sent them a tax return and HMRC
have sent them an email and a text to do so.
you've just got to be careful because there is a lot of fraudulent stuff. I don't think HMRC will contact you by text. No, HMRC will not contact you by text. Even the email address, you've got to be so careful because it might not always be HMRC. It might be someone that's created an email address that looks like HMRC. What I would say is, if you're in, look, first of all, you've paid the tax, so that's a good thing. They don't really chase you if you've already paid the tax. So to me, I would be careful. But what I would say is, if you're not sure, or you're not sure about how much you need to pay or how much you paid, whether you got any money owing to them, then I would say give them a phone call, but don't click on the link on the email because that could be fraudulent. Go onto the HMRC website, get the phone number from them, and ring that number. That is the way to deal with it. But HMRC will not send you a text.
I just wanted to add to that. There are many cases where this is fraudulent, and if you get an email or a text message, ignore it. If you have any, like Depesh says, something like phone them directly, because when I first received an email like that, I phoned them up and they said, ignore these because it's a hoax.
I think HMRC don't send emails to you.
It will be a letter.
It's always a letter. Email is more fraudulent. They want people to click on links. They can take over your system. There's a whole load of things that can happen. They can hack into your system. They can take over your bank accounts. Just be very careful of what you click on.
And most importantly on that, because they're so busy, they've got so many things on the go. They are not. They're after tax exchanges. They're not after us who are investing. So at the end of the day, we are little chickpeas to them. So they wouldn't chase anyone. So if you are in that situation and you have these letters coming in, please phone them up and check with them, because no one should be receiving anything from the HMRC by letter, email, or text. Definitely not by text. Definitely not by email. Normally by letter, but it's an official letter which they'll send out. And if you get a letter, look at the text itself, look at some spellings, look at the information on it. Kai odd lage, so ignore it. But you should not receive anything from them unless there is a major reason they need to. If there's fraudulence or something which is incorrect with your account, that's the only time they'll contact you.
Same Harish Bhai said, investing in shares connected ISAs, you could lose sometimes, right?
You could lose, correct, but you have to think about your objectives. You have to think about how long you're looking to invest the money for. So if you're thinking, I'm going to invest it for 1 year, 1 year is not really a sufficient amount of time because the markets can drop. So with any investment, we always say take a 5-year view, because things will happen in the markets. Yes, they'll go up and down. Now, when people say you could lose in shares, so if you put all your money into one single company, and if that company doesn't do well, then there's an increased chance you can lose your money. But if you're putting your money into, let's say, 10 different companies, let's say Microsoft, let's say Google, let's say Facebook, Tesla, Unilever, Mercedes, Sony, and Glaxo. So I've given you some different type of sectors. I'm not putting it all in like the same sector, like Barclays, Lloyds, Santander, Royal Bank of Scotland. We're not just doing banks. What we're doing is we're putting it into different sectors, and have some Amazon and have some Walt Disney as well, whatever, Apple, whatever. So what we're saying is by investing in those companies, the more diversification you have, within your portfolio, the better it will be. I think it's unlikely that all of those sort of companies would, where you lose money over a period of time. But with investments, we always say take a medium-term view. The investments we do, they're all managed by professional fund managers, and they're investing in 40, 50, 60 different companies. So you're really reducing your risk. So, for example, those 10 companies might only, well, even if they put 100% of your money into those 10, 20 companies that I've just mentioned, I think it's very unlikely that all of those, I think it's going to be virtually impossible for all of those companies to go bust. If all of those companies go bust, I think we're going to have major problems in the world where all of those companies go bust. But maybe one or two might not do well, but overall, over a period of time, yes, investments will make money. Key thing is diversifying investments, hold liquid cash. So just in case there's an emergency, you don't need to touch the investment, and leave the investment for at least 5 years. And when I look at investments over 5 years, most investments will make money. When you stretch it out to 10 years, the chance of making return increases when you're getting up to 10. And when you're getting up to 15 years, the probability becomes very, very good, very good, very strong probability of making money over 15 years. So certainly investments can make money, but make sure you hold a mixture of assets within your portfolio. So your portfolio can have shares, it can have funds, your portfolio could have ISA, it could have pension, it could have property, you might buy a bit of gold. You've just got to be aware of the different types of risks, but diversification is important, and always hold some money back in cash. Don't invest everything.
It's all about spreading the risk.
Diversification is key.
Sorry, same question from the same person again, Harish bhai. I'm 64. Can I still put money in my pension now and after I'm 66?
Yeah. So 64 is good if you're still working and you have employment income. So let's say you've got income of £20,000, or then you could put in £16,000 into a pension. You'd get £4,000 tax relief straight away. So if you're working, you can put in more because you've got the earnings to go with it. If you're 64 and you're retired, and then the maximum you can put into a pension is 2,880. And now it's still worthwhile because the government will give you £720 straight away to your pension. So your 2,880 will become 3,600. The whole 3,600 is available to grow. Now, with the 3,600, you've also got that buffer because some of it was your money and £720 was government money, just in case the market drops. You're not going into, you shouldn't really lose on your original capital. You can keep putting money into a pension until the age of 75. Also, we've got quite a few clients nowadays that they're just putting the money into, although they don't need the money themselves, they've got enough money, they're putting money into the pension because if you need it, you've got access to it. But also, the other good thing is that you're getting £720 straight away, and you get that every time you put in 2,880. So certainly worthwhile from that point of view. And if you look at the low interest rates, it'll probably take you 20 years to get £720 on £2,880 contribution. And from an inheritance tax point of view, it's outside of your estate straight away. So definitely worth it, 100% worth it.
Age over 75?
So 75 is the maximum age you can put money into a pension. After 75, you won't get any tax relief. So after 75, you don't want to put money into a pension.
Okay. Harish bhai, thank you very much. 3 important questions and lot to learn from. Sorry, Bhai's got one question.
Retire છીએ તો અમને ગવર્મેન્ટ નો કેટલો ટેક્સ
Free allowance.
મળે?
Free allowance.
83.
83. So you can't put money into a pension. Tamena na kisako.
Extra allowance. Can she get? Yeah. Yeah. If you want to. Okay.
એ લોકો અમારું પેન્શન કાઉન્ટ કરે ને
You're talking get to Malay. How much you get?
સ્ટેટ પેન્શન એન્ડ મારું હોય કંપની પેન્શન ઈ કેલ્ક્યુલેટ કરે અને પણ ગવર્મેન્ટ અમને ટેક્સ રિલીફ કેટલું આપે?
They don't give you any tax relief.
There's no tax relief.
So tomorrow income hoy more than 12,570 to tamne 20% tax ભરવું પડશે.
ઓકે હા હા
જેટલું વધારે હોય more than 12,570 pounds એમાં 20% tax ભરવું પડે.
Same as income tax. આપણે pay.
Income tax બરાબર.
અમે તો રિટાયર્ડ છીએ તો કેમ આવી રીતે એટલે મેં પૂછ્યું તમને. Okay.
Thank you. Thank you for that question, Ba.
Yeah.
Bhartiben is asking, Bhartiben Kara, please can you explain the gifting allowance from 3K to 12K?
So every year, your allowance, so you can give away £3,000. If a husband and wife can give away £3,000 each, so that's £6,000. And if you haven't used your allowance from the last year, that's also £6,000. So that's the £12,000 where you can use this year plus the previous year's allowance.
Thank you for that, Depesh Bhai. The other one, Suresh Bhai is saying, thank you very much for explaining in a simple word, so he doesn't have to read the complicated HMRC manuals. Bharat Bhai again is saying, like everything, simple things made more complicated. He's just making a statement. Not easy for many to understand. I assume any planning advice would be subject to fees, etc. Yes. Can you give a number for good stock broker? Good one. Gemini is asking. Okay, recording Anita's iPad. This session is on YouTube. Anybody can re-watch it as many times again and again. It's on RPM live events. It will be on YouTube. You can catch up on that. Again, Gemini is asking for your number. We will put your number in the chat. I mean, Depesh Bhai no number hamra chat ma lakhi nakhsu.
I'll just put the number in. Just type it in here.
Yeah. And
Put
Bhartiben.
that screen back on. They can take a photo of it.
Bhartiben Doshi is asking again. You know the £3,000 per child we said, is that per individual or per child? Does that make any difference? Or
We're talking about the annual gift allowance. That's £3,000. So the person making the gift, the adults making the gift, it's their allowance, not how many children you have. So if you got 3 children, you could give them £1,000 each. If you got 1 child, you could give that 1 child £3,000. But if you got 3 children, you can't give them all £3,000 each. So this is your allowance, 3,000, and it's up to you to split between the children. Doesn't matter if it's one child or 4 children.
so Bhartiben, just to make it clear, કે આપણે આપણા grandchildren ને કે children ને આપવું હોય, for example મારે આપવું હોય તો 2 children હોય તો હું 1,500 આપી શકું, એકને જ આપવું હોય તો 3,000 આપી શકું. એ આપણું પોતાનું અલાવન્સ 3,000 સુધીનું છે, એ તમારા ઉપર છે કેવી રીતે તમારે એને આપવા છે. બરોબર? મેક્સિમમ એટલે વધારેમાં વધારે તમે 3,000 આપી શકો. Sorry, Bai's got another question.
આપણે અત્યારે અમે છીએ હેરિટેજ ટેક્સ માં હોય તો જો કે છે 250 હું ઉપાડું તો એ કેલ્ક્યુલેટ કરવામાં ના આવે, પણ 300 કે 500 કે એવી રીતે ઉપાડતી હોય તો જ્યારે હેરિટેજ ટેક્સ આવે ઇનહેરિટેજ ટેક્સ ત્યારે એ બધું કાઉન્ટ થાય. એ સાચું?
If Ba wants to give it to as a gift to grandchildren, so every time she's been told, every time she withdraws money or gift someone, up to 250 is okay for anything over 300 is counted towards is that anything like that?
Inherited tax.
So how it works is the £3,000 you can give, you've got £3,000 allowance per person. The £250, if you want to give, if you want to hold a big party and you call 100 of your friends and you want to give each of them £250, you can do that, of course. But all of these things come in once. So they become more important if your estate is above £1 million.
Okay.
So if your estate is less than $1 million, then it doesn't matter. You can give whatever, but these things are to do with estates over $1 million.
Okay. Okay. એટલે એને કીધું કે આપણી જે કોઈની પ્રોપર્ટી એસ્ટેટ જે બધું ભેગું થઈ એકાઉન્ટ આ બધું ઓવર $1 million થાય તો 250 કે 300 કે 1000 કે 3000 તમે કેટલાય પાઈ ત્યારે કાઉન્ટ થાય એની અંદર હોય તો it doesn't make any difference, right?
The question I think what she's putting is that individual withdrawal
It doesn't
of
make any difference.
yeah. Individual withdrawals of £250. She was told if you make withdrawals of 300 or 250 plus, there is a commitment to pay inheritance tax on those. But how do they do that? I think that's wrong advice, isn't it?
That's wrong. At the end of the day, you might go to a cash point, take out £300, £50 you use for your shopping, and £250 you give it to your neighbor.
Yeah.
So or your friend, or your nephew, or your niece, or your grandchild.
Because like you said, if you have a party, you can give each individual £250.
Yeah. You can give each individual £250.
Yeah. Okay.
And is there a maximum amount in total that you can? That's total of £3,000.
Well, the 3,000 and the £250 should not be mixed up. They're two separate allowances. So let's say you've given the £3,000 to your children, your grandchildren, your nephews, your nieces, your neighbor, your uncle, your auntie. You can give all of those people £250, as many of those people you want to give, but you can't give them more than one gift of £250 to that person.
Okay.
અને આજે મારા ગ્રેન્ડસન ના લગન હોય તો એમાં હું કેટલા એને આપી શકું?
2,000 I think £2,500 you can give as a grandparent. Yeah, £2,500.
And if she was to just an example, if she was to pay towards something, does that count? Let's say for example, you're paying for one event.
Depends on what you're paying for. Some things the HMRC might consider it to be a gift, which if you're giving away more than your £3,000, then you have to survive the 7 years if the assets are over £1 million, correct?
Isn't it a case that it's any investment that any gift that you give where there is a benefit added to it, where if you're giving it as a gift and there's an added interest that you're earning from it, that's what's termed as a gift. But where it's not just giving it as an event or for a particular, and there's no benefit back to that person, it's not, it's accepted.
Yeah, gift is giving something away as a gift is different, and if you give it as a loan is different, because the loan always belongs back to you. It's coming back to you. So you're just going to be careful whether it's a gift or a loan.
Yeah. Okay. Thank you for that. Narendra's iPad's question is again. Thank you for your presentation, Depesh bhai. I have some shares and the value is down. How can I transfer them into ISA?
If you've got some shares, the value is down. Yeah, the value has probably dropped in the last since the beginning of January, between 10 and 15% across the global market. So how do you transfer those shares into an ISA? You would get in touch with the ISA provider whoever your ISA provider is, and they will give you the paperwork that will allow you to transfer those shares into the ISA.
Okay. Hope you got that question, answer to that question, Narendra's iPad.
And is there any fee for that?
That's probably.
There will usually be a fee for that, correct? Yeah.
Okay, somebody is saying if HMRC email or text is definitely a fake one. Is it good idea to set up a trust? I think that is a different topic, or could you cover in this?
Yeah, it's always a good idea to set up a trust. Trusts have been around for hundreds of years. It's a good way of certainly protecting assets in the event of things like divorce, bankruptcy. You want to make sure that the money stays within your family. And what it means is by putting it into a trust, because the trust can last a long time, it means that subsequent generations will not need to pay inheritance tax on the money is protected within a discretionary trust. So it's certainly worthwhile doing it. You've got £650,000 that you can put into a trust between a husband and wife without any chargeable lifetime transfer tax. And then after 7 years, you could put another up to £650,000 into a trust. So the trust allows you to do a lot of things. It allows you to give away money. It allows you to keep control. It allows you to protect the money for the benefit of the beneficiaries. So yeah, there's we see a lot of advantages for trusts. We have been doing them for a long time.
Is it just 3 years for kids ISAs to go back to top up? And Bakrania is asking, is it just 3 years for kids ISAs to go back to top up, like every 3 years, isn't it?
No, you can only do it in the current tax year. So you have to do it by the 5th of April this year. Whatever you haven't done, you're going to use the allowance. So next year, you'll get another allowance, which you have to use by the 5th of April, 2023.
It's not every 3 years, it's every year, every current financial year that they need to do this.
Every financial year.
What happens to pension money after the age of 75?
So pension monies nowadays will continue. Pension monies will continue, and now because of the flexible the changes to retirement plans, pension plans, it means that pension plans can now pass on to family, it can pass on to children, it can go to your grandchildren in the future. So pensions are great. You can put the money in, get the tax benefits. If you don't need it, before, long time ago, you would buy an annuity, and then depends on when you die, you'd have to live a long time to get the money's worth. But now with the changes in pensions, you can actually pass them from generation to generation. So it's really powerful tool for passing money down to generations, saving inheritance tax. For us, pensions are super efficient from a tax point of view.
I think you just answered. The next question from Geetaben is pension considered as out of estate?
Correct. Pensions are outside of the estate.
Yeah, thank you. Raj is asking, is it legal to put money into, I don't know this, but SIPP?
SIP. Self-invested personal pension, yeah.
Above 75 or above your earnings to just mitigate inheritance tax, even though you will not get tax relief on those contributions.
So the short answer is no. It is illegal. So if you got earning, so after 75, I don't think most providers will accept pension contributions. And if you're not getting any tax relief, I don't think it's that beneficial from that point of view. But you also, when you're putting in money into a pension, you have to have earnings. So if you're putting in figures over your earnings, then that's not going to be correct. So I wouldn't be surprised if the revenue get in touch with you and say you've overpaid into your pension, and these are the penalties.
Okay, thank you. That's a straight answer. No is the answer. Kanta is asking what amount you should put in pension. I don't understand. If your income is 66,000 to get child benefit.
So your child benefit, if your income is above £50,000, your child benefit starts getting reduced. Once your income is £60,000, there's no child benefit available to you. So the ideal situation, if you want to maximize the benefit of the child benefit, is put in a contribution that brings your income down to £50,000. Now, you might not necessarily want to put in such a large contribution to save the child benefit. And also, in some cases, it might not be possible. You might just not have the funds. So anything where you can bring your income down between 50 and 60 is going to give you a benefit. At 50, you get the maximum full amount of child benefit. 60, you get nothing. So it's somewhere in between you have to go to.
Thank you. Then a few more saying very good presentation. Thank you. Suresh Bhai and Chanda Ben's question: if we spend X thousand pounds for children's wedding, thank you, Suresh Bhai and Chanda Ben, is this considered a gift by HMRC in respect of inheritance tax?
So it depends if it's your income. So let's say you've got income of 100K, your expenses are 40K, and you spend another 50K on children's weddings, then that will not be, that money will be out of income. So it's not treated as a gift. Any money which is an income is immediately outside of your estate. But let's say your income is £20,000, you're spending £50,000 on the wedding, then the revenue will say that you've given away your capital. So when you give away your capital, you have, because spending money is the same as giving the money to the children. So therefore, the HMRC will say that you need to survive 7 years. The 7-year rule will apply in that scenario. But if you have sufficient income, surplus income after your expenditure, then they'll use the gift out of normal expenditure, and therefore that will not be subject to a 7-year rule, because income is different and capital is different.
Okay, thank you. I hope that helps. Next one is, if we have 4 grandchildren, Nalini Ben's question, can we pay £100 a month as gift? What taxes?
Can you pay £100 a month per grandchild? Yeah. Yes, you can pay £100 per month per grandchild. So just so that's £4,800 going. So £100 to 1,200 times 4, 4,800. So providing you've got income, then that will come outside of that will utilize your gift from surplus income. If you've got if you haven't got the income, then that can come out from your annual allowance, because you've got a £3,000 annual allowance, and if your husband or wife also has 3,000, so that could come out from there. But if you've already used that allowance somewhere else, then this would be treated as a gift. It would be treated as a gift. So we just got to be sure which allowance we are utilizing.
Okay, I think even I understood that very well. Nalini Ben and Jain Bhai, 4 grandchildren વચ્ચે આપણે 100 pound આપવા હોય તો 400 pound થાય, અને એના ઓવરઓલ 4800 કીધા ને તમે, તો તમારું એક જણાનું અલાવન્સ જે 3000 નું છે, બેયના થઈને 6000 નું અલાવન્સ હોય, તો તમે 3000 માંથી 1000 ક્યાંક ઓલરેડી ઇન્વેસ્ટ કરી દીધા હોય કે સેમાં આઈસા જ્યાં તમે મૂક્યા હોય, તો એમાંથી તમારે એ 2000 જ બાકી રહ્યા હોય, એટલે એ પ્રમાણે તમારે ગણતરી કરી લેવાની કે બેયના થઈને તમને કેટલા અલાવન્સ હજી બાકી છે તો તમે એટલા તમે ગ્રાન્ડચિલ્ડ્રન ને ગિફ્ટ તરીકે આપી શકો. Thank you very much. And then good advice and presentation. Thank you again. What are the costs associated with trust?
So what I would say is there's different types of trust that you can set up. There's property trust, for example. We put cash money into trust. So again, that's going to be slightly different. I would say if you want to know more about details of things like cost, it's probably best to arrange a meeting or just get in touch, and then we can go through that. But yeah, the different companies will charge slightly different amounts.
Thank you. Next question from Bharat Visani. If you pay 50K for your child's wedding, will that make? I think it's along the same. Hopefully that has been answered, Bharat Bhai. Will that be considered as gift by HMRC? But that question has been answered. Again, our Bharat Bhai is saying says global market crash due to Ukraine situation. What people should do, how long it would take to recover. Obviously, what should people, like money-wise, financial, what should people do? How long it would take to recover? Obviously, people may have to sit tight for a long time. It may recover just a thought. Again, I think that there's not a question there. Harish Bhai.
Yeah, so
okay.
So in terms of that, the answer is the markets where they've had sell-off, the recovery time is the market sold off in 2020. The market sold off between January, February, March. March was the lowest point in the stock market, and by the time we got to October, the market had gone a lot higher than the coronavirus levels. So you wouldn't have had to waited up till October. You would have been, so you're not talking a long time there. Where we've seen previous things like uncertainty caused by like the Russia-Ukraine situation. What the stock markets don't like is they don't like uncertainty. Once the announcement has happened that, okay, the war or whatever it is has started, then the markets will get back to normal. But before all of this stuff in January, markets were going up, confidence was good, companies were coming out with good profits. So they haven't suddenly become bad companies overnight. So there will still be investment opportunities. And if you look back historically, whenever there's been this sort of uncertainty, generally we've seen markets have bounced back fairly quickly.
Thank you very much, Depesh Bhai. Next question, not many more to go now. So Harish Bhai is saying, probably in connection to what we said about the trust will pay 40% tax on income like rental, right?
45%, the trust will pay tax rate 45%. But you might be able to claim some of it back depending on the tax situation. So if you're a 20% taxpayer, you'll be able to claim back 25% tax.
Okay, we live in UK, but if we have grandchildren living abroad, can we open ISA account for them?
No, because you have to be UK resident.
UK resident, that's fine, thank you. Galaxy A71 is saying they came late. This is for everyone, again, we'll repeat. This is on YouTube, so please don't feel you have missed out. You can watch it again, and if there is any questions as well, if you don't understand, please message us. And the number, Depesh Bhai's number is on the chat as well, so please take that number down. So please don't feel that you've missed out anything. Okay, Kanta is asking how, if you're not working, how do you put money in pension fund if you're not working?
So you can invest £2,880. So if you're not working, you're retired, you can always put in 2,880 into a pension and the government will give you tax relief. So everyone can put in 3,600 maximum without any earnings.
Okay, thank you. Are pensions outside even if you withdraw?
If you take the money out from the pension and put it in your bank account, then it's not outside of your estate, it'll be inside your estate. So nowadays, what we say to clients is, if you don't need the money in the pension, leave it in the pension as long as possible, because that's a tax protected environment. Plus it's growing, plus it's free from income tax, capital gains tax, and in the pension, it's outside of inheritance tax as well.
Brilliant. Rajesh Ben, yes, if you they're asking, is there a very good presentation, useful information? Can your company advise for will writing as well? Rajesh Ben, we did talk on that as well, but I'm sure you can look it up, and Depesh Bhai will briefly tell us at the end what other services they provide. Suresh Ben, Chanda Ben again saying thank you very much. Geeta Ben, thank you for the informative program. Can you resend your number, Depesh Bhai? I cannot see in my chat. Okay, we'll do that. In the meantime, I'll check any other private messages that has come through on Paresh's messages. Let's see. We don't want to miss any questions. Oh, sorry. I think, hold on. Just must have been. Shanti Bhai is asking, please, I think you will need to put in question in the chat, because, or you can take the number down. We cannot go individual questions. We do apologize. Time doesn't permit us to ask individual questions when the lines open up. માફી માંગીએ છીએ કે આપણે એક જણાને અત્યારે ચાન્સ આપી શકીએ એવા નથી. તમે ચેટમાં લખો, અથવા તો મને ફોનમાં ચેટ મેસેજ કરી શકો છો, અથવા તો પછી તમે દીપેશભાઈનો નંબર લઈ અને પછી તમે વાત કરી શકશો. પણ શાંતિભાઈનો આ મેસેજ હું વાંચી લઉં. Dipeshbhai, your way of explanation is very simple and understandable. Secondly, I have a question relating buying property. If possible for you, make me understand at the end, then I shall ask you the question. So, Shanti Bhai, I hope મેં કીધું એ તમને સમજાઈ ગયું હોય. માફી માંગીએ છીએ કે સમયના અભાવે આપણે એક જણાને પ્રશ્ન પૂછવાનો અત્યારે સમય નથી આપી શકતા. એના માટે ખૂબ ખૂબ સોરી છીએ. I think that's about it. Last quick whiz through for any private direct messages. No, that's about it. I think we've covered them all. Yes. Oh, Depesh Bhai, number lekho che for everyone who need. The last message on the chat is Depesh Bhai's, so everybody can see it. છેલ્લો ચેટમાં જે છે એ દીપેશભાઈ લખ્યું છે, તમે નંબર લખી લેજો. એની કંપનીનું નામ છે, અને હમણાં દીપેશભાઈ કહેશે પણ ખરા કે એ બીજા શું બીજી સર્વિસીસ ઓફર કરે છે, જેથી કરીને તમારે પછી પ્રાઇવેટલી તમને કાંઈ કામ હોય, તમને લાગે કે તમને વધારે કાંઈ પૂછવું છે, ઝૂમ ઉપર ના પૂછી શકો. અને અગેન રિમેમ્બર, ધીસ ઇઝ હિઝ પ્રોફેશન, હી ઇઝ ટેકિંગ આઉટ હિઝ ટાઈમ. આ એનું વ્યવસાય છે, એમાંથી એ સમય કાઢી અને આપણા માટે કરે છે. તમે આઉટસાઇડ ઝૂમ જાઓ, એ પછીના જે હોય, જે પ્રમાણેનું એનું હશે, ચાર્જીસ હશે, એ જણાવશે. તો એ ખ્યાલમાં રાખી અને તમે આના પછીનું જ્યારે તમારે ડાયરેક્ટ કોન્ટેક્ટ કરવાનો હોય એના એ કરી શકશો. બટ બિફોર વી આસ્ક દીપેશભાઈ વોટ એવર હી ડઝ, a big round of applause for a very clear cut explanation.
Yeah.
Very nicely explained. For especially even someone like me, I'm not very પૈસા બાબત તો બહુ નથી સમજ આવતી, પણ it's nice. That's what I mean, કે તમે જે સમજાવો છો, you can understand and it can relate to you and you can see sense. So that is what we need. એવું કોઈ simple રીતે સમજાવી શકે તો આપણે it's really helpful. So if Depesh Bhai can again, if you don't mind telling everyone of other services.
So we deal with all areas of financial planning. The key thing is to really understand your situation, make sure that the advice that we provide helps your situation, improves your situation. It's all about looking at the ways that you can save tax. So that will be ISAs, pensions. We set up trusts to deal with inheritance tax. We deal with life cover, whole of life cover. We deal with all areas of financial planning. And some things, even if we don't do it ourselves, we have other people that we work with, we refer to. So things like, although we don't do wills and power of attorney, we always recommend to the clients that, look, these are the things that you should consider getting done. Just purely because it's, for us, it's about making sure that we mitigate the different types of risk involved. We want to make sure that all of your planning is as good as possible. So whatever happens, your financial situation is in a good position. And then we meet up regularly with the clients because things will change in terms of budgets, taxation, allowances, all of these things will change in the future. So we're not the sort of company where we see someone once and then we never see them because things will change. So we always see the clients, we talk to them, we do a lot of Zoom meetings, we do webinars, and sometimes someone might not feel comfortable asking a question in an audience. I always say, look, there's no such thing as a silly question. If you want to ask something, I can probably guarantee it. Someone else is also thinking the same question, but maybe they feel afraid to ask the question. At the end of the day, shouldn't feel scared to ask any questions. But if you want to ring me up and just ask me something, then just give me a call, pick up the phone, give me a call, have a conversation, and I'll tell you what you can do, what you can't do, basically what the implications are. So yeah, we cover all areas of financial planning.
Depesh, again, thank you very, very much. Absolutely wonderful. And I'm sure everyone that has joined today has benefited from some advice from you today. So again, really appreciate you being proactive and approaching us and asking us to put these programs on, which is what we really do want, because you know what your industry is, you know where benefits are, and that's what it's all about, how we can benefit from financial planning. It's very, very important.
Once again, the program is on YouTube, so whoever joined in late, please, it's very, very important and very informative. So make sure you do watch it from YouTube. Go on RPM live events, and it will come up today's, or you can even put the date in, or you can put text as soon as you put in RPM live events, and it will come up. So thank you once again.
While you're there, Depesh, can you say good night to our YouTube family?
Good night to YouTube family. Good night to RPM family. Thank you for everyone for your time. Thank you, Paresh Bhai, Rohini Ben, for allowing me to do the presentation. And remember, there's only just over 5 weeks. So whatever you do, try and just make sure you utilize those allowances. Don't waste any allowances. If you're not sure about anything, just feel free to pick up the phone.
Brilliant. Thank you very much. So YouTube family, don't forget, tomorrow we're on from 6 o'clock for our Ghazal show. So don't forget to subscribe on the channel, ring the bell for notifications, and thumbs up for Depesh Bhai for this